Markets are sitting near record highs, yet the Fed is quietly handing out cash. Banks are borrowing billions from the Fed's emergency cash window, and the reverse repo piggy bank is almost empty. So, if everything is so great as they say, then why is the Fed quietly injecting the banks with cash? We know banks are seeing more delinquencies, but the new worry right now is liquidity. Liquidity is the fuel, the oxygen for the markets, the economy, credit, housing, everything pretty much. When breathing gets tight, you put in an oxygen mask. That's what the Fed is doing, giving banks air so the system doesn't suffocate. You can see it in the pressure system. SOFR, the overnight rate banks pay to borrow cash against treasuries, has been pushing up towards the Fed ceiling, even after the rate cuts. So if everything is so hunky-dory, why the oxygen mask? In the next few minutes, I'll walk you through Fed's recent moves, what's changing on the balance sheet, and how that flows and impacts markets. It's important to understand this dynamic because it directly drives how money flows into stocks and the real economy. At this point, you might be wondering who I am. If you're new here, welcome. I'm the trading actuary. Actuary is a fancy way of saying I analyze risk for a living. I analyze and forecasted billions of dollars in revenue for Fortune 100 companies. Now, I run my own AI, business intelligence, and risk assessment firm, and I've been investing and trading longer than I've been an actuary. With this channel, I want to share everything I've learned with people who share the same passion for finance, markets, and the economy, and also have constructive discussions to improve and grow together. I also run a free newsletter where I share my macro breakdown, chart setups, and trade ideas, all of it for free. If you want a more detailed weekly breakdown than what I can fit in my YouTube videos, the link is in the description below. Now that you know who I am, let's get this started. As of recording this video, markets are sitting at record highs. Yet, over the last few weeks, the Fed has injected more than $20 billion into the system. If everything is fine, why add liquidity now? Because the safety net is wearing thin. First, the reverse repo facility, the RRP. Money market funds lend cash to the Fed overnight and take treasuries back in the morning. When RRP is fat, there is spare cash to buffer volatility. When it's near zero, like right now, there is no cushion. That's when small headlines hit harder. Treasury auctions swing yields more, and intraday dips in small and mid-cap and high multiple names don't bounce as cleanly. With the jar empty, dealers and banks lean more on standing repo and the other overnight funding, which brings us to SRF. The SRF, the standing repo facility, is the Fed's always open overnight loan window. Dealers and banks post treasuries, get cash until morning, then reverse the trade. It's there to keep funding from ceasing. It is collateralized and resets daily. And it's not QE, even though a lot of people mix those up. We'll get to the QE and QT in a second. Recent SRF prints show a cluster, a few 3 to 7 billion spikes, with the most recent on October 23rd around 3 billion and totaling over 20 billion in aggregate. That is stress, but it's not panic yet. On charts, this kind of looks like late-day swings. Big names hold up, smaller, riskier names drop more, and because dealers and banks borrow overnight instead of selling. If the reverse repo, the RRP, is the cushion, the SRF is the short-term support until liquidity improves. When banks lean harder on overnight cash, the domino falls on SOFR. SOFR is the secured overnight financing rate. That's the average rate for one-night loans backed by treasuries, basically what a dollar costs until tomorrow morning. When demand for overnight cash outruns supply, the price gets bid up towards the Fed ceiling for those loans, and that is set up by the standing repo rate. That's exactly what we are seeing right now. SOFR is pressing the top of the range, meaning dollars are tight and overnight money costs more. Right now, it's sitting at about 4.24%, pressing the 4.25% ceiling. So, how does this impact our trade? Well, usually we get market opens with gaps like we've seen lately. Rebounds stall near the prior day highs, and the mega caps do the majority of the lifting while small and mid cap and high beta stay behind. Credit spreads also stay wider. So based on all this, what do we have right now? The cushion, the RRP, is thin. The overnight help, which is the SRF, is also getting busier, and SOFR is signaling tight cash. Now, let's discuss QE, quantitative easing, and QT, quantitative tightening, and also what we are actually in. QE is when the Fed buys bonds and adds new bank reserves. During that time, liquidity rises and yields usually fall. QT, quantitative tightening, is the opposite. The Fed lets bonds mature and doesn't replace them, slowly draining reserves and making markets more sensitive. Right now, we're in QT, quantitative tightening. The balance sheet is still shrinking, but given the recent liquidity injection I talked about earlier, we can call this QT with assistance. SRF and the discount window are keeping funding from seizing. If strain builds, the first move likely is a QT tapper, so slow the drain before any talk of QE. But most folks are already raising alarms that we are about to flip to QE as soon as the year ends, and have been promoting a wild pump in both crypto and stock markets. To this, I'll say be careful blindly following the hype. The way I see it, if we're forcing liquidity injections while in QT and then flipping to QE instantly, that doesn't sound too bullish to me. It feels like something might have broken in the system. We actually saw this in April with the whole tariff fiasco, when the financial conditions index slipped below zero. You remember what happened to the markets back then. Given the extreme concentration now, on top of bigger cracks since then, imagine how violent the reaction can be. I'll be tracking those moves closely in my free newsletter, so if you want to stay up to date, make sure you sign up. You'll also get trade ideas and the exact playbook I use to hedge my portfolio. Alright, now let's see which sectors will most likely be at risk when this gets more extreme. When liquidity tightens, the stuff with big stories and thin cash flow takes the punch first. I'm talking about software and other high multiple names, plus a lot of small and mid caps. So you will notice IWM fading faster and credit spreads staying wider. If the Fed decides to ease the pinch, the mega caps usually do the lifting first. And if the dollar dips on a cut, gold and energy should catch a bid. My game plan for now is I'm staying long my strongest names with real cash flow and clean balance sheets with a small slice of defensives for balance. I'm trimming the froth and the high multiple spots that ran too far. For protection, I still have my index put spreads, just enough for now that I don't have to panic sell good positions. I keep some cash so I can actually buy red days, and I scale in instead of chasing green candles. Going forward, I'll add risk if SRF comes down, SOFR comes off the ceiling, and breadth improves. I'll cut risk if SRF runs over 75 billion a day for a few days, if reserves drop well below $2.8 trillion, or if SOFR stays pinned and repo fails. Alright, that's my game plan for now. If you enjoyed this, please hit like and subscribe so you don't miss my future content, and it also helps the algorithm push this out to more traders. And drop a comment. What do you think is going to happen? Is this just a hiccup or the start of something bigger that most market participants are ignoring? And if you want to stay up to date and get full macro breakdowns, chart setups, and trade ideas with my weekly game plan, sign up for the free newsletter. The link is below. If you missed my last video on the banking crisis, basically why the Fed is in rescue mode right now, go watch that next. It shows the other side of what's happening and why. Thanks for watching, and I will see you in the next one.